we've heard that Nigeria remains compelling as a frontier market for foreign investors. Let's run through the kind of activity you're seeing from offshore investors right now and how that compares to local investors who are active in the equity space.
Good morning, Alishia. What we're seeing really is a combination of the offshore investors you mentioned and the local investors. From the offshore investors' point of view, we're seeing portfolio managers coming in and taking positions, especially in the food and beverage sector you mentioned and in the banking sector. And they like the valuation of a lot of those stocks now. And they see Nigeria, especially with political moves taking place, as a safer bet now to invest in going forward. And domestic investors, I mean, with a crash in the domestic money market rates, which moved from about 17% for 30-day deposits in December to an average of about 2 or 3% now, I think a lot of investors, especially in the pension funds as well as other local institutional investors, are going back into equity to get better returns.
Well, undoubtedly, we have the banking sector stealing much of the spotlight and dominate things, with there being pretty mixed reactions to the results we've seen come to the fore thus far. How are you digesting the numbers, broadly speaking, at the moment?
I think broadly speaking, what we've had is numbers from 3 institutions which were seen as part of the top tier of the Nigerian banking sector. So people expected them to have some profits, but wanted to really see what their loan loss provisions were like and how the asset book, the quality of the asset book. And what we've seen from, especially from Zenith and GTB, is that the quality of the asset book is pretty good, considering what has occurred in some of the rescued banks. For example, Zenith, the net interest income increased by about 60% in the fourth quarter of last year, which is a pretty good result and shows the quality of the asset book. And GTB is a quite impressive result. I think UBA was slightly disappointing in terms of their profit after tax had dropped by so much, and might suggest that their asset quality isn't as high as GTB and Zenith. But to be honest, UBA, their strategy really has been this Pan-African expansion, and that's where their focus has been, and that has led to them to keep their eye off the ball for the domestic market, to be honest.
Well, if we look a little bit more in depth into GT Bank's numbers, I mean, they were out with numbers yesterday. The market clearly impressed with the figures and the fact that they had a dividend being declared and bonus shares being issued as well. What were your overall impressions there, where we did see this 22% fall in full year pre-tax profit? Not much surprise, one would assume, coming to the fore.
No, I think the fall in profits wasn't much of a surprise. I think it was in line with what most analysts were expecting from GTB. GTB has always had a reputation for having a good asset book. The fall in profits is really to do with a downturn in the market, drop in investment rates. For example, the investment rates in FGM bonds, which a lot of the banks are investing heavily into, I mean, 20-year has dropped from about 13-14% average in 2008 to about 7% average in 2009. So that's affected their income. I think there's no formula in line. I think from a dividend point of view, in 2008, GTB had a 1 naira share dividend with a 1-for-4 bonus. And for them to have a 75 kobo dividend with a 1-for-4 bonus in 2009, despite all the problems in the sector, I think has given investors, kept investors very happy and showed consistency in their results.
Well, certainly that the upside of declaring those dividends, but one of the brokers I was chatting to last week was saying that he was getting a sense that these companies are issuing dividends more as a gesture of confidence in their operations and to assure rather the investment public rather than boast a really healthy, a healthy book at the end of the day. Do you share that sentiment at all? Because one would have assumed that many of these companies would be conserving cash right now, especially with consolidation that's being anticipated within the space.
But it depends on the strategy of the firms. GTB has not expressed any interest in taking part in any consolidation or merger acquisition activity. So in a sense, they have a strategic decision. Do they conserve cash, which they don't intend to deploy in merger acquisition? So that means that cash will have to be invested, probably in FGM bonds, or which have pretty low yields at the moment. Or do they give that cash back to shareholders? I think they decide to make that decision. I think what you'll see is that banks like First Bank and FCMB, Access Bank, Fidelity, that have shown some interest in the merger and acquisition activity that's ongoing. They are more under pressure to conserve cash, and so their dividends will probably be much less than people expect.